Good afternoon, I'm Jennifer Christian and I work as a portfolio specialist in the investment management team, and I'm going to provide you with a brief overview of this week's market summary. Oil was the main focus at the start of the week after last Sunday's drone attack on Saudi Arabia's oil facilities, which took out half of their oil production, roughly 5.7 million barrels a day, which equates to around 5% of the total global supply. While the attack sent the price of crude oil sharply higher last Monday, it was important to note that even at the highs of the day, just shy of $70 per barrel, Brent was only back at the level it was at the end of May 2019. However, news on Wednesday that Saudi Arabia had already restored around half the oil production it had lost, and that output will be returned to pre-attack levels by the end of September, quickly pulled the rug out from under the oil price. This is positive, as higher oil prices could have exacerbated the global economic slowdown we are currently experiencing, as higher oil prices are like an additional tax on our incomes and thus a headwind to economic growth. Also, on Wednesday, the Fed cut interest rates by 0.25% to a range of 1.75 to 2%. Although the move was widely expected, we were surprised and disappointed by how hawkish the statement was, that policymakers appear reluctant to cut interest rates further, believing the US economy is solid, with the dot plot suggesting no more cuts this year or 2020, and higher US interest rates in 2021 and 2022. Needless to say, Donald Trump tweeted his displeasure, saying Jay Powell and the Federal Reserve fail again. No guts, no sense, no vision. However, given the current economic uncertainty and mounting downside risks to global economic growth, we believe that the Fed stance will be difficult to maintain and policymakers will be compelled to take further action. As such, we expect a steady stream of additional monetary policy easing to occur at their upcoming policy meetings. In the UK, although the Bank of England left interest rates unchanged at 0.75%, they have finally acknowledged that inflation and business investment is weak, which gels with our opinion that UK interest rates should be cut. However, the Bank of England again reiterated their previous statement that gradual and limited interest rate increases are likely in the event of a smooth Brexit to keep inflation under control, despite the fact that a smooth Brexit is highly likely to result in a stronger pound, which would be deflationary as the cost of our imported goods fall. Additionally, this week's CPI inflation data showed that inflation had slowed to levels last seen in 2016. Headline CPI fell to 1.7% from 2.1%, which is well below the Bank of England's 2% target, while core CPI, which excludes volatile items such as food and energy, slowed to 1.5% from 1.9%. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.